But let's move on. And in a relief for banks, the Reserve Bank of India has eased liquidity coverage ratio norms, giving them more flexibility in managing funds. Ritu is joining with us on the phone line to give us more details on this one.
Good morning, Winnie. RBI has released this much anticipated final rule on how LCR will be calculated. And it's a huge breather for banks because these amended rules are less stringent than what was proposed in the draft earlier. And they will only come into force from the next financial year, that is FY27. So to begin with, banks are required to set aside lower stock of liquid assets against the deposits that they raise through digital channels. So RBI has prescribed now an additional runoff rate of 2.5% to internet and mobile banking enabled retail and small business customer deposits versus 5% that was proposed in the draft. Consequently, the stable internet and mobile banking enabled deposits will attract a 7.5% run rate now, and the less stable deposits about 12.5% run rate. Also, the final guidelines rationalize the composition of wholesale funding from these other legal entities, and therefore non-financial entities like trust, educational, charitable, etc., they're going to attract a lower runoff rate of 40% against 100% that is applicable currently. Now, as a result, RBI says the net impact of these measures will improve the LCR of banks by around 600 basis points, and banks will continue to be able to meet the minimum LCR requirements. Now, ICRA estimates the banking system's high-quality liquid assets that they maintain are at about 45 to 50 lakh crores, and therefore this move can free up lendable resources by almost 3 lakh crores and lead to a 1.4 to 1.5% potential increase in credit growth for the system.
Okay, Ritu, thank you so much for that. We'll surely keep an eye out on where this is headed as well. And banks also is something that we'll keep an eye out on today.